Hello there, welcome to Market Call. David Burrows is our guest. He's President and Chief Investment Strategist at Barometer Capital Management, and he'll be taking your questions on North American large caps. 1-855-326-6266, or you can email David right now, marketcall@bnnbloomberg.ca. David, thanks for joining us.
Great to be here.
Maybe we just put up a quick intraday chart of NVIDIA or Meta, because they started higher after Trump has backed down on some tariffs on tech, but they have turned negative now. So it looks like there's still a lot of selling pressure on these big techs.
Yeah, look, you know, the tariffs are one thing, and they're a big thing. But there's a lot of stuff going on in the market. And realistically, tech has been going through a shift since June of last year. You know, way before we even thought, you know, the Trump administration would be the Trump administration. And so certainly tariffs have accelerated moves in some sectors. But the reality is, whether you're looking at semiconductors or whether you're looking at, you know, the Mag 7 or whether you're looking at growth stocks in general, the market's been rotating. So there are headwinds. You know, at the end of the day, this giant build out for AI is a big deal, and AI is going to be, you know, I'm sure, a big theme going forward. However, the structural, the infrastructure that's been built is going to weigh on these big tech companies for some time. They're going to have a lot of depreciation that they're going to have to write off, and you know, it's possible that there's some overbuild. But the market has been sending this message for quite some time, so it doesn't surprise me that, you know, investors who've made a lot of money in these stocks think, here's my opportunity to buy them cheaply. I would just encourage people not to have FOMO right now in growth, because it's just no indication that it's returning to leadership anytime soon.
We're really excited to have you here, David. David Burrows is our guest today on A Market Call, and he's taking your questions on North American large caps. 1-855-326-6266, or email us, marketcall@bnnbloomberg.ca. North American large caps are on the menu. Started the show talking about NVIDIA. We have an email on that very topic. Do you think now is a good time to get into NVIDIA since it's gone down, or would you buy a different tech name?
Yeah. So let me pull the lens way back. It's really important we understand the market we're operating in when we look at individual names. And I run a relative return chart, and this is going to sound crazy, gold versus QQQ.
The
or
NASDAQ
gold versus
ETF.
Semiconductors.
Okay.
On a very long-term picture, gold turned up relative to both semiconductors and the QQQ in the first quarter of the year 2000 and outperformed until 2011, when it rolled over and tech took over a mantle and rallied for the last 13, 14 years. So in the last 18 months, gold has once again turned up relative to semiconductors, and it started happening a year ago and has been pretty steady since. So I'm not one for making big, bold comments, but I would say right now what's happening in tech is not healthy. And while NVIDIA held up much longer than most of the semiconductor index, when things get difficult, they get the strongest stocks. So I would say every stock in the semiconductor index right now is technically broken, so you're hoping. I think it's a great company, but you don't have a tailwind from the sector. And one of the biggest mistakes I watched people do through 2000 and 2001, which is when I started coming on BNN, specifically to tell people they needed to know how to sell. Don't have FOMO. If this thing gets technically fixed, there'll be a long way you can go with it. But right now it's broken. The semiconductor sector is broken. It is lagging and has been since June of last year. It's very possible we've built in a lot of expectation going forward for all of the great things that are going to come from AI. But you know, in 2000, we'd built out a lot of fiber for what was going to fuel the internet. And it was a long time till those stocks made new highs again. So I would be cautious. I would not be a buyer.
Of any big prominent tech right now?
Right now, as a firm, and this has been for quite a while, we have about a 0% tech weight. And being on this show over the last 6 months, we've talked about that progressively.
Let's head to London, Ontario. John, go ahead, please.
Thanks, Andrew. Hello, David. It's good to hear from a steady voice of reason. David, you mentioned the tech bubble and the precipitous decline in 2000. Then we had 08, 09, the double bottom. Then we had early COVID when we had a pandemic-induced decline. Now we've got a self-manufactured decline. What sectors will lead us out of this volatility quagmire? And maybe you have a pathognomonic stock in that sector. Thank you.
Thank you.
So we are big believers in tracking breadth across the market. Which sectors have the highest percentage of stocks performing well? And where is it improving? Where is it weakening? Now, you get into a tough decline, almost everything gets impacted. And this decline has been similar to that. The last group to break down was the financials. And within the financials, insurance companies were the strongest and have not broken down through this. If you look at Fairfax or Berkshire or Intact, any number of companies in that sector performing well. And on the bounce over the last couple of weeks, have bounced pretty nicely.
And you mean property and casualty insurance?
Property and casualty, yeah. But financials as a broad-based sector. And whether you're looking at them in North America or in Europe or in Asia, the financials are the best performing sector aside from precious metals, which is obviously a different story. So listen, I would be a buyer of JP Morgan just as a broad-based financial. It's the strongest. Now, we've been fans of JP Morgan since it made its first new highs in 2013.
JPM,
JPM, and it's one of the larger positions in the firm. But we also really like Fairfax Financial, and Fairfax is trading as though there's nothing going on in the market. So both of those names, I think, would be companies. And I think realistically, we are in an inflationary environment. We are likely to have a second wave of inflation, especially due to these tariffs. Financial services companies benefit in an inflationary environment.
Let's head to Burlington, Ontario. Go ahead, Mary, please.
Hi, Andy. Hi, David. Thank you so much for taking my call. David, I'm wondering, in the past you've liked M&T Bank. I heard what you just said about financials, and I'm wondering if you still like M&T Bank or if you don't. Thanks very much. I'll hang up and listen.
So the problem with regional banks is they are probably the most closely tied to the U.S. domestic economy. And when I look at market signaling, what's happened with crude, what's happened with some of the other commodity prices, there is a risk we are headed to recession. And when you think about the regional banks, they have a lot of real estate exposure. They also hold still a lot of treasury bonds. And as we know, the treasury market has not been very friendly. And it was the first group within the financials to break down technically. So I would not recommend buying a regional bank right now. Of all the regional banks, the one that's hanging in the best is Regions Financial. But even there, I just wouldn't put money to work there now. So we are being very cautious. We do have cash in our accounts right now, sort of 35 to 45%, which is a lot. But until I see a change, and even on this bounce that we saw over the last week, the regional banks did not bounce.
Right. RF being the symbol for Regions Financial, based in Birmingham, Alabama.
Yeah, but as a group, I will admit we are short the regional banks in our macro strategy. So I think that there are better places that you don't want to be a hero in a time like now. You want to pick your spots, and the relative strength has been weakening on the regional banks since November.
Okay, Deborah, thanks for the... oh, no, we do have Deborah now. Sorry. Deborah in Okanagan Falls, BC. Fire ahead, Deborah. Good to hear from you.
Oh, hello. Good morning, gentlemen. David, I'm an avid follower on X, and I really enjoy your teaching sessions with Barometer readings.
Oh, thank you.
It seems like we're asking a lot of financial questions today, so my question today is on the Bank of America. The chart is very telling. It's telling the story of, obviously, of the sign of the times. I'm going to ask you, is this an entry point? And finally, what is your cash position at this time?
Yeah. So we're currently, depending on the portfolio, 35 to 45% cash, 10 to 15% precious metals, and about 10% global ex North America. Because strangely enough, global stocks are performing better than US stocks, even though they're the target of tariffs. Partly that's because 31% of the MSCI All World Index is financials. And they are holding up better than every other sector other than precious metals. So I would prefer you looked at a JP Morgan than a Bank of America currently. They both have big capital markets businesses. JP Morgan has the rock solid balance sheet, probably has the best technology platform, probably has the best management. So I would be more inclined to lean towards JP Morgan.
Okay. Thanks for the question, Deborah. We're going to be back with David Burrows, and he's taking your questions on North American large caps. Let's head to Sarnia, Ontario. Colin, go ahead, please.
Well, thank you, sir. And David, my question's about Teck Resources. I currently have BHP, which I've had for a while, maybe at a 3-4% level, and I want to add Teck because of all the good stuff that's going to be built in the USA. And I just thought it'd be good to be maybe in the end 10% copper miners. Is that overweight, or what do you think about Teck in general? I know you've owned it in the past. So.
Yeah.
Thanks.
So, Colin, one of the things that we do when we're in a choppy market and when breadth is weakening, we stop putting any new positions on. So we're just not putting new positions on today. But we're always building a farm team, things that we would like to own, things that are fundamentally sound, good, getting better, and that are technically sound. So the long-term picture for Teck Resources and for the copper miners is very, very favorable. It's a giant base that's been built going back to 2011. But as you can see on the screen, in the near term, technically not so good on a daily chart. So I'm watching with interest. And I've said this on, we do a webcast every Tuesday at 4 o'clock. And I've said I'm watching these copper stocks with interest. However, last week when we really got a couple of bad down days, the copper stocks really broke. And so, actually the week before. So that's one of the things that tells me we may be headed to a recession, and it is self-inflicted in the US and we'll get hurt in Canada as well. So it's just, you don't want to be buying a copper stock if you think that there's a higher than 30% chance of a recession, and my guess is there is right now. So I like the company. They've got dynamite assets. I think they're going to cash flow a lot, but we have to see things get a little better before I want to put money to work right now.
We have Elliot on the line from Hamilton, Ontario. Go ahead, Elliot, please.
Good afternoon, gentlemen. Against this highly volatile backdrop, I thought perhaps the Chicago Board Options Exchange would do better. Is there something company-specific? Please, could you address the exchanges and CBOE in particular? Thank you.
So I was sitting yesterday, I probably went through 1,000 US charts, I probably went through 600 Canadian charts. And, as I say, we're building a farm team. What is it that we want to own if our breadth models start to get better? One of the top 10 positions at the firm is the TMX group, letter X, and its chart looks almost identical to CBOE, which looks almost identical to CME, the Chicago Mercantile Exchange. All of the exchanges are trading well. Right. The volumes are strong. They would do even better if we see more financings take place, which is not happening in the near term. But look, I always love to see what is it that holds up in the face of weakness. That's the market giving you the message as to where you might want to go later. And so CBOE, I would certainly have on my list. If I think there were 45 stocks that hit our tests yesterday, and both CBOE and CME were on there. Of course, we own X already, so we don't need to add more. But I think certainly it looks great. It's traded better than 92% of companies in the S&P 500 over the last 12 months. It got nice, steady earnings growth in front of it, and nice dividend growth.
Right, and that stock hit a record high there just last month, and it sure has done well. Yeah. We were having a bit of trouble with the chart. We've got Nicole in Montreal. Go ahead, Nicole, please.
Hi, guys, and David, you're the best, my favorite. I wanted to thank you first for suggesting Howmet Aerospace. I've done very well, and just wanted to know, looking forward, what do you think of this stock? Have a great day. Bye-bye.
Howmet Aerospace.
Yeah. So the industrials as a sector are a really mixed bag. You've got transports on one side that really look quite horrible, and on the other side you got the aerospace and defense stocks, and they've been dynamite. Relative strength has been improving for aerospace and defense since September of 2022, before the market made its low, and it has steadily improved since then. So Howmet is a company we've owned over the last 12 months. They do forged blades for jet engines. They make a lot of other forged parts. In the absence of new jet engines coming, the replacement cycle is meaning that there's a lot of business at high margins for Howmet. And so I think that this is a great company. It's making a relative strength new high today versus the market. It has been incredibly resilient, and I think that one thing is clear. Part of Trump's policies will be to steer countries into spending more money on defense. Interestingly enough, there's an ETF in Europe, EUAD, which owns the European aerospace and defense stocks.
Okay.
It's been on a rope. So this whole sector, I think, looks quite strong, and realistically, it's very predictable because the contracts are long-lasting, and the economy slows down, unlikely to get hurt.
Right, that European, Howmet's doubled in the past year, and that European one in the past year, actually, sorry, just since October, is up 32%.
Yeah.
Okay, Albert in Cobourg, Ontario. Go ahead, please.
Hello, gentlemen. I know that you're a big proponent of using stop losses on all of your positions. I was wondering if you could explain to myself and the rest of the viewers what strategy you use. Do you use a fixed price? Do you use a trailing stop loss? Are you doing anything different now, given the volatility of the market, than you were in the past?
Yeah.
Thanks, and I'll listen to your response.
Thanks.
Albert, I think it's a really important question. To be successful over cycles, you have to be a good seller. And at the end of the day, you need 20 or 30 companies in the portfolio. There's like 6,000 we can choose from. It's okay if one doesn't work. Realistically, if we put on 20 positions, 2 or 3 work out way better than we thought they would. 7 or 8 are pretty good and a bunch don't work. So your success as an investor is tied to your ability to hold your winning positions and get the heck out of Dodge on the ones that don't work, right? So every position that we identify and want to enter, we come to a stop loss limit below the price we're paying. And as positions work out as we hope or expect, we'll ratchet stops in behind. Now, every security has a different personality. Some are very low volatility, some have more volatility. And so we have to understand what we're taking on. What I'm looking for my stop loss level is a change in the personality of that stock, right? Where something's been making higher highs and higher lows and starts making a lower low and lower highs and lower lows. That's a change, right? You've gone from the odds being in your favor and the wind at your back to the odds against you. I use point and figure price charts. They're an old-fashioned type of technical chart. They're made of X's and O's, and I've been using them for 40 years. However, you can do different things. As a longer-term investor, you can use the 200-day moving average or the 150-day moving average. If somebody has a shorter-term view, you could use a 50-day, but you're going to get stopped out a lot. But what we do then is we say, well, what's my risk to stop on each position in the portfolio, and what's my total risk to stops if I wait it out? And that has to be a number we can live with. The fact is, the reason that we have a big cash weight is we raised some when breadth got weaker, and then we've been stopped out of a lot of stocks. And the good news is, at some point, things will get better. Rarely do we just V-bottom and take off like a rocket. In the current circumstance, it's unlikely that between today and tomorrow, everything's going to get reversed and everyone's going to forget about the tariffs. We're going to go through a process here. So there will be time to see what's stronger, time to see what doesn't pull back the next time we make a low versus the market. That gives you another clue. But the stop is really, really, really important.
Albert, thanks very much indeed for that question. When we come back, we're going to have a look at David's past picks. David was on our show April 22nd of last year. Brookfield Corporation, BN, was his first idea. This one holding up, 26% gain.
Yeah. So we no longer own it. We did get stopped out at $77. I think Brookfield's a great company. The one thing that I would say currently is if you look at some of the companies that are more private equity focused, like Carlyle and so on, they are having a difficult time in this market. Partly, I think, because so many private equity companies have used leverage in the deals that they've done, and the cost of credit is going up. Some of the real estate deals that have been done have not worked out quite so well. So we've stepped away from the private equity, private credit type situations.
Right, so that's just
and Brookfield would fit in there.
For sure. NextEra, a huge electricity producer in the United States.
Yeah, so NextEra is the fastest growing utility in the U.S. However, they also have significant wind exposure. And about a year ago, this would be last summer, things got more difficult for the utilities in general as yields went higher. And so, again, we sort of had to step away from the utilities. This has been a year where there's been a lot of rotation, especially since June of last year, as inflation assets started to outperform and things that acted more like bonds started to really weaken.
Okay. Sorry, would you stick with NextEra then? Not calling to you.
So here's the thing. In a weak market like we're in right now, the utilities have held on pretty well.
Okay.
And we own Hydro, Ontario Hydro here in Canada.
And that's done well.
And it's been great.
Yeah.
However, the sentiment on clean energy has changed. And so NextEra is caught up in that.
Okay. Yeah. Trump wants coal brought back, it seems.
Yeah.
Alimentation, Couche-Tard. This went down. It appears some investors have misgivings over the scale of that possible 7-Eleven takeover.
Yeah. So, when the 7-Eleven takeover came up, this was months ago, we said we've been stopped out of this one. This is one that we would probably step back into if they had been able to get a transaction done. But that's just not the case. This is a company that's been great. We have a big position in Dollarama, and Dollarama and Loblaws have been our two core positions in this area, and I would prefer both of those.
Okay, Loblaws
or Dollarama?
Dollarama, yeah. Just too many moving parts with Alimentation right now?
Well, I think the reason they're looking at a transaction is their growth opportunities have slowed. If they were able to make that purchase, they would have lots of opportunity for additional efficiencies and additional growth. In the meantime, Dollarama is just chugging along, and Loblaw is certainly chugging along. I actually thought about using Loblaws today as a top pick.
We're going to be back with David Burrows of Barometer Capital Management. The topic, North American large caps. So let's put up that number, 1-855-326-6266. Or you can email David right now, a market call at bnnbloomberg.ca. Kevin is in Toronto. Go ahead, Kevin, please.
Hi there. David, thank you for taking my call. It's on the TD Bank. I'm tempted to jump in, but I have a feeling, the market moves like one big stock. Where the market's up, all the stocks are up. And it sounds like you're a bit bearish. And I'm wondering, would there be a better time to get into TD Bank and just the market in general? Thank you very much.
Thank you.
So look, we have a process, and our process is when breadth or the percent of stocks in clearly defined uptrends is very narrow and narrowing, we don't add new positions. So that holds me back because we're very systematic in our decision making. Having said that, we have a lot of companies that are in our farm team that are coming from financial services. And it doesn't matter whether you're looking in Canada, the US, Europe, or Asia, the financials have been the most resilient group in the market. So some are more economically sensitive, like regional banks. Some are more market sensitive, like the big capital markets banks. So, you pick your spots. We have avoided TD Bank since it got into difficulty, back in 2022. And we haven't gone back. There are a lot of shareholders that are stranded at higher prices who would be sellers if they got their money back. And so we tend to stay away from companies that have a lot of that to fight through. Our big position has been RBC in Canada. RBC is leading in wealth management. They have a great capital markets business. They got a great balance sheet, very well managed. And so I would lean there first if I was leaning into a Canadian bank. And I think you probably could buy it here. We aren't.
You could buy TD or RBC. Sorry, yeah.
We're just not adding, period, right now. JP Morgan would be my favorite in the US, I mentioned. Same thing. The best continues to be the best, right? When you get into a sloppy market or where there's a question mark, that's what you want to own.
Right.
So I think that I would lean more towards an RBC than a TD. And it may well be that TD is getting things swung around, and we won't be the first ones in. I just think that there's maybe more work to do there than there is at RBC.
We have Ross calling from Windsor, Ontario. Go ahead, Ross, please.
Hi, good afternoon. Thanks for taking my call. I'm a long-term holder of Onyx Corporation, and it's pulled back a fair bit in the last few months, and I was thinking of possibly adding some more. And I was wondering David's opinion on Onyx. Thank you.
Yeah, look, Onyx has been a great stock, but like any of the other companies that are focused on private equity, they're under pressure. One of the big issues for the private equity companies is many of them sitting on positions that have sort of come to term and where their investors are looking for liquidity. And it's hard for private equity companies right now to get liquidity on any of their previous deals. I know because when things get tough at the private equity companies, they start reaching out to firms like ours to say, how would you like to get in on some of our privates while they're still private?
Right, yeah.
And I know they're doing the same across retail brokerage as well. And that concerns me because if that's the exit they're looking for, that's not the exit they planned on. So I would just stay away. We have looked at the world this way. The power for 40 years was in the hands of the borrower while rates were falling. Private equity companies are huge borrowers. They use cheap debt to leverage up a deal and then sell it back out into the public. I think power now is in the hands of the lender because in rising rates, you have the ability to get paid. So I would steer clear of the private equity companies, Carlyle, Apollo, Blackstone, Onyx.
Just before we go on, maybe we could put up an intraday for General Motors, GM in New York, or Ford, F, because there's a headline here that President Trump says he's looking at helping car companies with tariffs. No details yet, but obviously that could be good news for Canada if there's less disruption for the auto industry, and General Motors stock and Ford stock reacting to that comment by the president. We'll stay on that story. John in Toronto, go ahead, please.
Well, hi, good morning. I heard your earlier comments on Dollarama. I am a stockholder for quite some time, and I think they execute well their business. But I just wondered maybe you can expand a little bit farther out why the stock has jumped so quickly more recently.
Yeah. Look, the Rossi family have done a great job with this company. They have had just fantastic growth against the backdrop of the dollar store sort of sector, way outperformed versus the U.S. peers. I think companies like Dollarama and like a Loblaws, which is obviously different, but grocery, will likely take the opportunity to take price as we see tariffs come in. So the opportunity to expand their margins certainly is there. We look at these companies based on their revenues, and if they can expand their margin just a little bit, it makes a big difference. And I think that's why these companies are hanging in as well as they are. But I don't want to take anything away from the management group here. They've just done a remarkable job. This has been a long-term holding of ours. It's a top 10 holding at the firm. And look, it's distinguishing itself in a very tough market. Now, if we have an economic slowdown, consumers are going to trade down and look for discounted brands. In the case of Loblaws, 60% of their earnings come from their discount brands. So they step away from Loblaws and go to No Frills. But both of these companies would be beneficiaries of that trend.
Nizar is calling from Scarborough, Ontario. Go ahead, Nizar, please.
Oh, hi, Andy. Hi, David. May I have your thoughts on Manulife Financial, please? I recall Manulife Financial met your good getting better criteria. Will this still be the case for this life co with its extensive Asian operations vis-a-vis Trump tariffs, which are coming on Asia, especially China? I heard your earlier positive comments on financials. Thanks for taking my call.
Thank you.
Well, this is where stop losses cut two ways, and I do think that this is a wonderful company. The stock closed one night about 3 weeks ago at 42 3/4, and the tariffs hit, and it opened the next morning at 39. And so we were stopped out because it took out the low at like $41, $40.75. It's not that we think any less of the business, it's just our discipline, and we got stopped out on this one. I will say that the life insurers, are fundamentally in the right spot, but until, this is now trading below the 200-day moving average. That's sort of an important line in the sand. Broke down on the point and figure chart, so we had to step aside.
So generally, when you see a stock go below the 200-day moving average, it gives you pause?
Not many good things happen below the 200-day moving average.
Right.
So you could use that as a simple rule as a longer-term investor. And, on the bounce, it has not been able to regain the 200-day. But on the point and figure price chart that I use, it broke the lows, and so it's gone. And, frankly, right now, having more cash gives us flexibility. I don't know, this could be one of those times when you have a quick reversal in the market. My guess is that a lot has changed in the last month in the way we look at the world, and it's going to take some time to sort out.
We're going to be back with David Burrows. He's taking your questions on North American large caps. 1-855-326-6266. Charlie's on the line from Grand Prairie, Alberta. Go ahead, Charlie, please.
Good morning or good afternoon, gentlemen.
Hi there.
My call is on MDA on the Toronto Stock Exchange. I've been a holder of this stock since, probably 5 years now. And I'm wondering if this is a good time to get back in. I'll hang up and listen to your response. Thank you.
Thank you.
Hey, Charlie, that's a great question. MDA has been a very successful business. We spent a lot of time looking at it. One of our portfolio managers was talking about it this morning, and it's on our farm team. It's been incredibly resilient going through this little downturn. They make low-orbiting satellites. They have a deal with Apple to provide satellites into a new network that they're building. There is some discussion around a potential acquisition in the U.S., which would be more like a merger of equals. And that would be quite interesting, although it might require some financing. So we looked at it. We will watch to see if there is a financing done, and if there is, and markets are a little better, we probably would participate in it. But I think it's a great company, and holding up really, really well in the face of a weak market.
We have Mark on the line from Vancouver. Mark, you're on the air.
Oh, hi, David. Hi, Andrew. phoning about preferred shares in general. I love the less volatility of the preferreds, and I'm really attracted by the high dividend yields. I'm wondering what the downside here is. It looks great in terms of the stability, and in particular, I want to know about Bombardier. I mean, they're offering about 8% yields right now. BCE has about 10%, but I want to know your thoughts on Bombardier in particular and their potential. And thanks. I'll listen to your response.
Thanks.
Yeah, look, the preferred market is not a homogeneous market. Every preferred share has its own set of terms and conditions. And you really need to know what you're buying. So there's a fellow who's been on BNN before, Doug Grieve, who I think is excellent at preferreds, and he runs a fund specifically that invests in preferred shares. He's a pro. I'm not an expert on preferreds. On the particular preferreds you're bringing up, the thing you have to look at is, can it be called away if rates go lower, which often is the case. Very often the terms are set up in the company's favor. So it gives them flexibility and you less flexibility. But I'm simplifying here. I don't have enough information about the two that you're asking about to give you an answer.
Okay. We have Gulam in Toronto. Go ahead, Gulam, please.
Hi, good afternoon to you both. My question was on uranium, the uranium sector. I don't have any exposure to that, and I was thinking of EFR or NextGen. Would you have any preferences, or is there a favorite stock you like in that sector? Yeah. And if not, then I can go into ARC Resources because I don't have any exposure to natural gas.
Yeah.
So like your opinion, please.
Sure.
Thank you.
So in this pullback, uranium stocks have been pulling back since November, before the market started to correct, and so that's one strike. Second strike is technically in the near term they're all sort of broken. The long-term picture for uranium, I think, is excellent, but when something isn't behaving the way you would expect it to, given what you think maybe you're missing something. If you look at URA, which is the ETF that owns uranium stocks, it's pretty technically broken. If you look at Cameco, and I have some myself in my pro account right now. I wish I didn't, but I do. I don't think I'd add to it here until you see something change for the better. NextGen, has an aggressive long-term plan, but again, the stocks come from 12 to 6, and I'm not in the business of trying to pick bottoms. I just think maybe you let this develop a little bit first. U.UN is another way to play it. That's the Sprott uranium units.
Right.
Again, technically, I can't make a case. So if I really wanted to own something in the space, again, I would probably go to the leader, and I probably would own Cameco. But I just can't recommend it right now. That the group is under pressure as a sector.
Okay, and we have Mike in Simcoe, Ontario. Go ahead, please.
Yeah, hello, David. I'm interested in the life insurers. Specifically, in my case, it would be Great West Life, or would you go with Power Corp in that situation?
Yeah.
Thank you very much.
Great question. So we own Power Corp. As a diversified financial, this is a great stock.
And it's the parent of Great West, yeah.
And Power has been, a great dividend payer, a great dividend grower over time, technically hanging in really, really well. I could own Great West as well. Both would fit our tests. And so, I would consider it. I think we talked about Manulife earlier. Exposure to China for Manulife probably has hurt them in the near term. But you don't get that with Great West or with Power. I would probably go with Power as a great long-term hold and a great long-term buy. It's basically trading at the 50-day moving average, and the yield is great.
Okay, yeah, yield of 5.1%. Right, we're going to get David's top picks after this. Energy fans have a treat coming up tomorrow on Market Call. Our guest is Eric Nuttall, partner and senior portfolio manager at 9 Point Partners. He's taking your questions on oil and gas producers and energy service stocks. And if you missed a Market Call, as if that would ever conceivably happen, check out our daily podcast. You can find it on iHeartRadio and other podcast platforms, and there are full episodes on our YouTube channel. First idea, wheat and precious metals. That one actually hitting a record high today.
Yeah, I've talked about a bunch of different gold stocks over the last year, and Agnico would be our biggest holding, and I think it's a great stock. For the person who doesn't own something currently, or maybe is a more conservative, longer-term investor, wheat and precious metals is a great way to get exposure. This is by far the strongest theme in the market. Mm-hmm. My belief is that we are like 1 year into a multi-year bull market in golds, and there will be pullbacks. My guess is it's interesting. Last week was like the first week there were inflows into the GDX Gold Miners ETF. There have been no private investors moving into this space. Mm-hmm. It's been largely central banks buying gold. However, Wheaton is a great way to participate. They've got 18 different mining properties they have exposure to. Of course, they get a royalty from gold and silver production. They are in safe jurisdictions. It has great dividend growth, and this is a way that you can get exposure to rising gold and silver prices. They are about 40% gold, about 60% gold, 40% silver exposure. They've got a great balance sheet with no debt. They've been able to finance a lot of companies who will pay them for a long period of time. And so this is a great holding for any portfolio.
We got Expand Energy as your next idea. This used to be called Chesapeake Energy.
Well, so this was a merger of Chesapeake and Southwest Energy in the U.S.
Oh, okay, yeah.
So what is the trade after the trade, right? We're in a correction right now. Maybe it's a bear market. I don't know. But the trade after the trade is we're going to need more energy and more power production in the U.S. and around the world. Natural gas is going to be the first stopgap to do that. There is a lot of intention to export more liquefied natural gas in the U.S. And so Expand EXE is the largest supplier of gas into the Gulf Coast LNG liquefaction industry. They are realizing all kinds of synergies from the business combination. Mm-hmm. And so we don't know yet how that will impact dividend growth going forward. They do have some debt they're going to have to pay down. Mm-hmm. But what you want when you own a gas company is the gas company with the most in the ground. And so there is economic risk here. But I think that as things normalize, natural gas is an industry we should be focused in. I've talked about ARC Resources here previously. We own that in Canada. Mm-hmm. Same thing for the LNG exposure. I think this is a solid pick.
Okay. And then your final idea is cash. So you're cautious right now, David.
Look, I've had people say to me before, you're always bullish. And that's really actually not the case. We played defense all the way through the financial crisis and through the tech wreck in 2000 and the turn down in 2015. And there's a time to be aggressive and there's a time to be more cautious. And I think right now there are so many uncertainties, probably never more uncertainties than any other time I can remember.
Wow.
Having some cash gives you flexibility. Mm-hmm. Some of the best investments you ever make are when you see something start to really hold up when the market retests a low. Mm-hmm. And we're waiting. This may be a very short-term issue, or it might be a more long, drawn-out process. My guess is the news flow is going to stay bumpy. Mm-hmm. Investors don't like uncertainty, and I like to have an opportunity, an option to make some investments as we see leadership become clear. And there's no race.
David, we better leave it there. Thank you very much indeed. Let's have a very quick look at the markets before we go. And you can see they are turning up, but as I highlighted earlier, some of the big tech stocks in the United States are showing signs of weakness. NVIDIA now up. It was down earlier, now poking up slightly. And there's NVIDIA. We have seen some pressure, though, on Tesla. Last time I checked, it was down around 1%. And Amazon.com down about 2.5%. So it's not an across-the-board ripping rally in the tech stocks. Alphabet is holding in, but Broadcom is down about 2%. And let's have another look at a couple of these U.S. automakers intraday. President Trump talking to reporters in the Oval Office. I'm looking at something to help car companies. They're switching to parts that were made in Canada, Mexico, and other places. They need a little bit of time because they're going to make them here. And we did see a rally for some of those automakers after Mr. Trump's remarks. Looking at the Toronto market, TD is hanging in there today, up around 2%. Shopify is slightly weak, and that's always going to be a drag on the TSX with its massive weighting. Shopify down about 1.6%. So it's by no means a massive move into the tech stocks today. I'm not seeing any other really significant movers in Canada. Oh, just to confuse us, Celestica is up. And of course, that's a tech stock for many people seen as a play on chips and NVIDIA and data centers, up around 2%. Thank you very much indeed for watching Market Call. Eric Nuttall is up tomorrow.